Well, Raluca and Ana, you both work for KPMG's European Tax Center, and there's just a heck of a lot going on in the EU today. And the thing I want to talk about now is the defensive measures that were agreed at the EU level. Raluca, perhaps you can refresh us a little on what those actually are.
Hi, Rodney. Good to see you. Yes, so as part of the EU's work in relation to third countries, so non-EU jurisdictions, we are all very familiar with the EU list of non-cooperative jurisdictions. So we have the so-called blacklist and the gray list. Blacklisted jurisdictions are the ones that have already been found by the European Union to not be in line with the European Union's tax good governance criteria, and the jurisdictions on the gray list are the ones that are being monitored by the EU for non-compliance. So this listing process has been going on for the past 6 years or so, but we are very often asked, what does it actually mean for a country to be placed on one of the lists? And what happened in 2019 was that EU member states agreed with the European Commission to implement one of a list of defensive measures. So this is not a binding exercise. It was just a promise that member states made to the European Union that they will introduce targeted measures against taxpayers that operate in listed jurisdictions. And the measures that they could choose from were non-deductibility of costs. So when a payment is made to a listed jurisdiction, that payment would be non-deductible in the member state where it originated. Another type of defensive measure could be in the form of control for a company regulation, so CFC rules. Another way to target jurisdictions on the list is by imposing higher withholding taxes on payments through those jurisdictions than would otherwise be applicable from that country. And there's also the possibility to apply a limitation on a participation exemption on profit distributions when those countries are involved. And of course, member states can apply more stringent administrative measures as well. So this was the list of measures that member states could choose from. It's also maybe worth mentioning that both lists are relevant in the context of public country-by-country reporting. So for member states in the EU, but also for jurisdictions on the blacklist and in certain instances on the gray list, country-by-country data will have to be disclosed publicly, whereas for the rest of the world, data can be disclosed in aggregate. So that's another part of EU legislation where these lists are relevant, but that's not part of the defensive measures package.
So interesting, Raluca. And so member states had options as to what particular measures they could choose to enact.
Exactly.
And Ana, I know that you've been doing a lot of work at the EU Tax Center to look into just what have member states in Europe been choosing to enact, or how to approach this. What have you been finding as you go through that analysis?
So one of the key message that we have is first of all, because as Raluca was saying earlier, this is not a binding instrument, so member states have more liberty than to a regular directive to choose the measures that they want to implement, and also because they have those 4 different options they could choose from. The key trend that we found is that there's a wide disparity between how member states chose to implement and to approach the defensive measures. For example, let's just start with the countries against which the restrictions apply. We have some member states like Cyprus or Germany or Ireland that directly refer in their legislation to the EU list of non-cooperative jurisdictions. Then we have other countries like Belgium or France or the Netherlands who choose to take the countries from the EU blacklist and then include them in their own local list of tax havens. And then the last category would be a few countries like Greece or Italy or even Poland that have chose not to connect their list or to their tax haven list with the EU list. But even in their cases, most of the countries that are on the EU blacklist also appear on their own domestic tax haven list. And then the complexity is actually compounded by the fact that in these countries, changes to the EU list do not always translate into an immediate effect. For example, we have countries where the relevant list is the one that is at the end of the financial year. And then we have countries in which, in order for the EU list to have effect, or to any changes to the EU list, to the EU list to have effect, they need to be implemented in their local law to a piece of legislation. And then coming back to the key point, which are the actual measures that were implemented by the member states. Based on the responses that we received for our survey, all member states have implemented or are in the course of implementing at least one of the defensive measures. And then we have 4 countries, which are Germany, Latvia, Lithuania, and Portugal, that implemented all the suggested measures. And I just want to sum up with an example of one country, which is France, where if you have transactions with countries on the EU list, you can actually face really significant tax burdens. For example, in case you are not able to demonstrate that the reason for the transaction was not tax evasion or tax avoidance, taxpayers can actually face up to a 75% withholding tax applicable to payments to these countries on the EU list, as opposed to the regular withholding tax rate in France, which is the 26.5%. So a lot of different way of approaching the list, and a lot of different domestic lists that needs to be monitored by the taxpayers.
Well, certainly something like a 75% withholding tax catches one's attention very quickly. But I think a key message, Anna, you're sharing is this really isn't a cookie cutter, one size fits all. Different countries have gone in different directions, albeit within the framework. But it really means that you do need to look at this almost on a country by country basis to understand what rules will apply and obligations exist.
Yeah, that's correct.
Fascinating. And so, okay, so a little bit of crystal ball gazing, and Raluca, I'll turn it back to you. Understanding that patchwork of rules and approaches that Anna just laid out, where do you think this is going in the future, if you had to guess?
So I think there are 2 points to keep in mind here. One is the future of the EU list itself. So as I've said, this has been going on for a while, and the listing criteria are constantly being revised by the European Union. They are looking into adding further criteria that have already been in the works for a while. So, for example, disclosure of beneficial ownership information, that's something that they promised to include as a listing criterion a while back, but they're still discussing on how best to do that. Pillar 2 might feature as compliance, or the introduction of the minimum tax would be a new criterion as well. So this whole exercise is likely to continue to evolve in the future. Also, countries are falling off the list, or they are put back on the list again in case they fail to comply with the deadlines that the European Union has set for them, and so on. So that's one side of the story. The list is now being updated twice a year, in February and October of each year. So that's one aspect of the exercise. And the other one is what is going to continue to happen with the defensive measures that we've been discussing. So what the European Union have promised to do is to now evaluate the way member states apply these defensive measures. So they did an initial exercise where they looked at what legislation member states had introduced, and now they want to take a step further and see what that actually means in practice. And once that they've gone through that exercise, they will be in a better position to see if there is anything that should be done at EU level to better coordinate the application and the introduction of these defensive measures. So we might see in the future that the introduction of such measures is more aligned and more harmonized than it is at the moment. And one other point where the European Union is investigating with the tax authorities in member states is how they approach this from an administrative point of view as well. So not just the concrete legislation that was put in place, but also what it means from a tax audit perspective. For example, do they investigate dealings with listed jurisdictions more thoroughly than they would in other cases? So there are a lot of these discussions happening behind the scenes as well. So I guess the main message is that this will continue to evolve, and it's important to see on a country-by-country basis how member states are approaching this exercise.
Well, this is certainly sounding like a watch the space as it dovetails with public C/C, disclosure of beneficial ownership, ongoing countries coming in, maybe going out. Thank you both for your time. I can only imagine how much work it is to sort of keep on top of this and help our clients figure out on almost a semi-annual basis now what they need to do to stay on top of these defensive measures.
Yes,
Good catching up with both of you, and I trust you have a good day.
Same to you too. Bye-bye.